studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Schedule 9 is used to report the relationships that exist between corporations. At first, the terms related corporations and associated corporations may sound similar, but in Canadian corporate tax, they have different meanings and different tax implications. Let's begin with related corporations. Two corporations are generally considered related when there is a family relationship or an ownership relationship connecting them. For example, corporations owned by members of the same family, or a parent corporation and its subsidiary, are often related corporations. Associated corporations are a more specific concept. They are corporations that meet certain rules under the Income Tax Act, usually because they are under common control or satisfy specific ownership tests. These relationships are important because associated corporations are subject to special tax rules, such as sharing the small business deduction limit. This is why Schedule 9 exists. It allows corporations to disclose both related and associated corporations to the Canada Revenue Agency. Unlike many other schedules, Schedule 9 is primarily an information or disclosure schedule. It does not calculate tax. Instead, it provides CRA with the ownership and relationship information needed to apply other corporate tax rules correctly. One concept that often confuses beginners is the relationship between these two terms. A helpful way to think about it is this. Every associated corporation is related in some way through ownership or control, but not every related corporation is associated. Some related corporations may never trigger the special tax rules that apply to associated corporations. The key takeaway is that Schedule 9 helps the CRA understand the corporate structure behind the tax return. Before calculating taxes, the CRA first needs to know how corporations are connected. And that's exactly the purpose of this schedule. The easiest way to understand the difference between related and associated corporations is by looking at a few practical examples. Let's start with related corporations. Imagine a father owns one corporation and his son owns another. Because the owners are members of the same family, the two corporations are considered related through family ownership. Another common example is a parent corporation that owns 100% of a subsidiary corporation. Since one corporation controls the other, they are also related. Now let's look at associated corporations. Suppose one individual owns 100% of two separate corporations. Because both corporations are under common control, they are associated corporations. In addition to being related through common ownership, they are also subject to the special tax rules that apply to associated corporations. Another situation involves family-controlled corporations. For example, a husband controls one corporation and his wife controls another. Depending on the ownership structure, voting rights, and the detailed rules in the Income Tax Act, these corporations may also be considered associated. This is why tax professionals carefully analyze ownership, rather than relying only on family relationships. A simple comparison can help you remember the difference. A parent corporation and its subsidiary are generally both related and associated. Two corporations owned by the same individual are also both related and associated. Corporations owned by different family members are usually related, but they are only associated if they satisfy the specific tax rules. Completely unrelated shareholders, on the other hand, are generally neither related nor associated. The most important point to remember is that associated corporations have additional tax consequences. They may have to share the small business deduction limit and comply with other special corporate tax rules. Related corporations, however, often require only disclosure unless they also meet the conditions to be associated. Whenever you're analyzing a corporate structure, think in 2 steps. First, ask, are these corporations related? Then ask, do they also meet the rules to be associated? Following this approach will help you classify corporate relationships much more accurately. In practice, completing Schedule 9 starts with understanding the corporation's ownership structure. Before you can determine whether corporations are related or associated, you first need a clear picture of who owns what. Begin by asking your client a few simple questions. Do they own any other corporations? Who owns those corporations? Is there any family ownership involved? Is there a parent company or any subsidiaries? The answers to these questions help you map the complete corporate structure. Once you've identified all of the related corporations, the next step is determining which of those corporations are also associated. This requires applying the specific rules in the Income Tax Act, particularly the rules dealing with common control and ownership relationships. After identifying the relationships, collect the required information for each corporation. This typically includes the corporation's name, business number, ownership percentages, and the type of relationship. Once the information is complete, you can accurately prepare Schedule 9 and report the corporate relationships to the Canada Revenue Agency. There are several common mistakes that beginners should avoid. One of the biggest is confusing related corporations with associated corporations and assuming the terms mean the same thing. Another is overlooking indirect ownership through holding companies or family members. Some preparers also forget to consider family ownership when analyzing relationships or submit incomplete ownership information on the schedule. Before filing the return, review your work carefully. Confirm that you've identified every corporation connected to the client, analyzed whether each relationship is merely related or also associated, and completed the ownership information accurately. The most important thing to remember is that Schedule 9 is primarily a disclosure schedule. Its purpose is to give the CRA an accurate picture of the corporation's ownership and relationships. Once the CRA understands the corporate structure, it can correctly apply the various corporate tax rules, including those relating to associated corporations, business limit sharing, and other compliance requirements.